Hi everyone, welcome to the weekly stock market update. Let me know you can see and hear me loud and clear, because that would be absolutely wonderful that you can. Let me know where you're from if you're a first timer, and we're going to kick off with a poll. It's the election tomorrow in the UK, so let's just start off with that. We've got Zurich, Switzerland. We'll play against England and we'll win. Stefan, you never know. Even as an England supporter, I'm not going to be strong on that one. Okay, welcome everyone. Fantastic. Can you hear me? So let's get on with the update. And we're also live on TikTok. Hello, TikTok. We're live on there as well. So kicking off on the weekly stock market update. Now, this is interesting. Goldman Sachs say this has a flavor of 1995. I guess what they're saying, which is actually good news for us who are invested in our pensions in US equities, what they're saying is 1995 went from 100 to 130, a 30% return. And year to date, 2024 is turning out a little bit like that. Lots of money to be made then, I guess. That's the bottom line of what you would take from that. So it's looking positive. Whether or not you agree with Goldman's, I guess, is another issue. But certainly I'm very pleased with those kinds of returns. Remember, 55% up on the NASDAQ last year, and the S&P was up 25%. That's my forthcoming book to be published by the Financial Times. I've put on TikTok that this is a promo. It's not actually really a promo for the book. I probably get about £1 in royalties. What really I'm saying is this is not individual financial advice. I don't know you individually. It is educational material for you and informational as well. So there's the warning beforehand. Okay, now, stock market update. What are we going to talk about in all of this? Well, we're going to go through all of those things you can see on screen. Okay, so let's start straight away. And I'm also answering questions. Now, look at that data. That is interesting, isn't it? Derek from Buckinghamshire. We've got Dublin, we've got Plymouth. We've got Fulham, we've got Bath, we've also got Auckland, New Zealand. So like I said, let me know where you're all from. I tell you what's interesting in terms of the 88%. I'm going to stop the poll in a second in terms of who do you think is going to win. 86% of you think Labour will win the general election. Okay, now, first half, if it's more than 10%, is a good signal for the rest of the year. Now, year to date, we've had more than a 10% rise. In each of these years that I'm going to show you and highlight here, in each of these years, we had more than a 10% rise. What happened for the rest of the year? Well, on average, you get another 7.5%. 83% of the time, it's positive. You might as well go nuts. Well, I have 3 times leverage S&P 500 index exchange traded fund. 3 times leverage. Now, that's my risk appetite. So if we get 7, I should make a 21% return, assuming it all moves in a straight line, which of course it doesn't. But anyway, most years are positive after a very strong start. Of course, 87, for those of you young enough to remember that, was an exception. Anyway, that's from Goldman's. Up to you what you make of it. It's just interesting, I thought. US equity market is worth now 57 trillion US dollars. That is the market cap. Now, just to put that into context, the GDP of the world's largest economy, the United States, is about, I think it's about $20 trillion. So the market cap is 57 trillion. Why am I saying that? The reason I'm saying it is this. You will know I've campaigned to teach 1 million people how to make an additional $1 million into their pensions over their lifetimes. And it really does become easier when you consider that US household wealth hits a record 160 trillion in 2024. That is an all-time record. Americans are getting richer, and it is in no small measure not just because they've got a big economy, but because their stock market goes up. Where are their pensions invested? Think about it. Now, as a Briton, I want access to that in my SIPP and ISA, and I can get it. Okay, and I thought these two were very telling because that's the reason why. Oh, I've just realized I've not shared the bloody screen. How stupid am I? Apologies, people. Thank you for pointing that out to me. How stupid am I? There we go. You should be able to see the screen now. Let me start off. How stupid am I? I have done that once or twice in the past. So for anybody who started late, that's Goldman Sachs. It has a flavor of 1995 is what they were saying. Look at that nice little rise. You should be able to see the screen now clearly. Thanks for pointing that out, Adam. Okay. And the others who said thanks for pointing that out as well. That's what I was pointing at when I said about the book. The update. Now, that's the data. Whenever you're up more than 10% in the first half of the year, for the rest of the year, that's how you're doing on average. By the way, feel free to take screenshots or take images of any of this from your phone, because you might want to look at the data later. But yeah, if it's up on average the 7%, and I've got 3 times leverage, then I should be making 21. That's the data there. Okay. Thanks, Derek. Apologies, I've gone crazy. I have done it before, so it's not as if I've been distracted by being live on TikTok. Now, US equity market is worth 57 trillion. There's the number. I mean, look at that growth. And that's just from 2015. It's doubled. That's their stock market. And that's household wealth. It's 160 trillion. Americans are rich, and they're rich because of the stock market. And I want you to have access to all of that. That's my point. So now we're all caught up. There's no interesting earnings coming out this week, so don't worry about it. They've got the 4th of July tomorrow, of course, anyway. Their independence from Britain. I say we take them back. Have you seen who they've got as presidential campaigns? And we make it a colony again. And we get our hands on some of that multi-trillion dollar wealth that they've got. Anyway, bring back the empire, separate issue. Let's look at how quick it takes to double the money instead. We want to see how long does it take to double your money. Now, I've shown this before. 15% per annum takes 5 years. Well, I'm going to show you already how quickly we've gone up. Well, since October of last year, up 28%. That doesn't happen every year, but it's 15. 15% is the number to double your money across 5 years. If your IFA wealth manager hasn't done that, well, it's probably because they don't have US exposure. So how are these stocks doing? Okay, that's the 0%. And what this shows is the various sectors. Okay, now I just show this out of interest. I'm going to show you the stocks that I like at the moment in a second, but there is, these are, I'm going to come to elections in a second, but these are basically fundamentally what you're seeing on screen. I think I'm actually sharing the wrong screen. Actually, I'm going to show you the other screen in just a second. What you're actually seeing are some sectors, okay, pretty much you could pick anything and you're going to make money, is the bottom line. That should be easier to see. Okay, like technology. Okay, you pick technology and pretty much everything's going up. Financials, yes. Communication services, consumer, staples, not so much. Real estate, definitely not, right? It's a real mixed bag. Now, I don't go by picking sectors. People say, oh, surely you want to be in a winning sector. Well, actually, no, I want to be in a winning company. And if the company has got a tailwind, which I'll judge by the broader market, then it should do well anyway. Yes, life would be easier if the sector also had a tailwind, but if it's a winning company, it's going to be resilient, should do well in any event. The problem with trying to pick the sectors, it'll then disguise rubbish companies, because actually what you're doing is you're gambling on individual sectors, and you may well just gamble on the sector rather than doing proper due diligence on the company, which is what you actually should be doing. Oh, recently, well, busy past week, I hosted some political hustings. I was also at some award ceremonies as well. Quickly share that, but that's enough of that. Now, before I go on to the stocks and how we've done this week, look, I keep saying to people, it's important to have the option of holding cash. Now, you might say, wait a minute, stock market at all-time highs in the US, and you're talking about holding cash. And this is the reason why. Yes, I know the good times. This is meta, by the way. I know the good times are great. Look at that 63% drop. Now, we got out of it for a very simple reason. If you follow me on Telegram, you'll know. And it's that, the monthly MACD falling below its own moving average. Okay, really simple rule. I've mentioned it in my books. You'll have seen my books time and again. Okay, you'll have seen me mention Investing Unplugged. I'll make sure you can get a free copy of that. It's on alpeshpatel.com/links anyway, and I'll make sure that that's available. I'm going to close the poll. Now, that fall That fall was avoidable. The reason to get in here was it was on then the approved filtered list afterwards. Okay, and the monthly momentum wasn't falling. What's the approved filtered list? Well, it's this thing. You'll be familiar with it. And I need all these 5 columns to be green for the stock to be considered, which is what happened with Meta, right? Keeping it really simple. And what I'll explain what those 5 columns are, why they're important, i.e. undervalued, high growth companies delivering strong cash flow, revenue growth, momentum, high average returns, low volatility to the downside, and have a tendency to outperform the market. Okay, so if you think I've missed something, do let me know. And you might think, well, what about directors' dealings? No, because the academic research shows they're actually very hit and miss. And there's other things which I'll explain I don't include. So the point is, the reason it's important to hold cash sometimes is because you want to avoid that. You want to avoid snakes and ladders and losing 6 years of your mortgage and your pension. And as you will know, time and again, because fund managers can't do that, they wipe out your pension. Okay. And also they say, well, buy and hold. Look, Alpesh, buy and hold. You got 0% over 2 years. Yes, but we got 170% over 2 years because we missed the drop and we got the gain. Now, that's an extreme example, which worked out very well for us. Our insurance policy, our making sure if the monthly MACD drops, don't be in the stock. That all worked. It worked wonderfully well. Okay, it might not work in the future, might have all sorts of other reasons. But what I'm saying is it's an extreme example. It shows you why you've got to have the option to hold cash. And you can't have that with IFAs and fund managers because they will want you to be paying their fees and in their product. Well, for fund managers, they can't even hold cash anyway, more than about 5% of it. They have to be in equities, even when the equities are burning the house down. So I wanted to draw that very important point to you. And a classic example of that is Scottish Mortgage Investment Trust loses 50% of its value in that year, 2022, because of its exposure to equities, and it can't hold cash, and you just have to burn and see your pension drop 50%. So for those of you who think fund managers are experts and can protect you from downside volatility by holding lots and lots of stocks and all the diversification in the world, absolute nonsense. Okay, they will burn your money and destroy half your pension. And if you don't believe me, just ask your IFA or wealth manager, how did you do in 2022? Okay, and they will always have done poorly because they have to hold bloody equities. They were idiots. It was a year in which not to hold equities. Okay, and this is not new. That's 2011, let alone now. There's 3 economists I follow, and I've written about in my books and in my Financial Times columns and on my Bloomberg TV show. They're Daniel Kahneman, Eugene Fama, and Richard Thaler. Well, the middle one of those, Eugene Fama, all 3 of those won Nobel Prize in economics. He explains and goes into great detail on why this is the case, and I've published their work in my books, which is that the fund managers essentially can't hold cash is one big reason. How's the past week been? How's performance been? Let's look at that. Yeah, Apple, great week, 5%. Microsoft, Amazon, let's start with the ones that I had. Tesla in the past week up 23%. We'll come to that in a second, a little bit later on as well. Broadcom, 4%. Nvidia took a bit of a break. The banks did well. Everything else pretty poor. So tech and software and banks did well. Everything else, including healthcare, not so much. Now let's break that down and look at specifics and look at companies possibly worth investing in yet. Okay. And I'm going to come to Tesla in a second. Year-to-date performance, stonking. I mean, look at that with Nvidia, Microsoft, Alphabet, Facebook, Apple, Amazon. Am I happy? Yes. Right? Obviously. Now, what I had to do in April, as you will know if you follow me on this, is rebalance the portfolio because since January 2023, we had a shed load of money in Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia, amongst the others. Those were the biggest up movers. And to the extent that even a tiny move was causing my son's junior ISA to lose thousands because of how big the gain had been since January. So in that rebalancing, I got rid of Meta. I did sell half of Apple, but bought it back shortly after. And I did sell Nvidia, but have bought half that position back again. And it was done purely for rebalancing that I sold. I should only have sold half to begin with, but there you go. Right now, the point is those positions continue to be held. If you watch my weekly broadcast, this will not come as news, as does JP Morgan, for instance. So how do we get to those, and what's my view on the markets? And I'm going to come to that. But as for exchange traded funds, for the TikTok audience, crypto, yeah, good luck to you. I try not to mention crypto, because as soon as you do, you get a whole bunch of fraudsters leaping onto comments as well, and trying to get you onto Telegram and all sorts of things. So it's basically now becoming a dirty word. It's a bit like saying OnlyFans. There's some legitimate stuff that goes on where people teach you how to cook, but there's stuff which, you might not want your parents to see. So there you go. And it's the same with crypto. It's just become a fraudster's paradise and money launderer's haven and terrorist backyard. So I'm just staying away from it. Okay. Or staying away from discussing it anyway. Exchange rate funds, there they go. I'll talk about some of the leverage ones that I hold. Leverage is risky. Don't do that at home. Now, buy and hold. As I mentioned earlier, you don't want to buy and hold indefinitely. It's stupid. And Meta is a classic example of that, because you get 0% over 2 years. Whereas if you've got some simple way of exiting, like monthly MACD falls below its moving average, then you save yourself a 60% drop. It's really simple. Nothing is guaranteed to work. If you're looking for guarantees in the stock market, you're an idiot. Okay, apologies to the idiots on here. There won't be any, of course, because you're my audience and you're lovely. But if you're looking for guarantees, you don't get them. You get probabilities in the market. That's what you get. Okay, so by us being able to get in there, and this was an example of one which, as I said, worked incredibly well. Well, they won't all do that. That's 190% versus 0. Now, your IFA, when they say to you buy and hold, you tell them, oh, so you want me to get a 0% return? Where's your expertise? Why could you not just simply have told me to get out? And they'll say, oh, no, we wouldn't ever do that. Oh, no. Oh, no. And so you're happy for me to lose 6 years of my pension? Oh, yes. Well, that's fine. Don't worry. Buy and hold. They're idiots. And we know they're idiots because the Times does investigations on the idiots who are housed at St. James's Place, for instance. I'm not sure they're so much idiots, negligent, or just fraudsters. I've not quite worked out which category they fall in, because they know that they're going to force you to hold cash in a falling, hold equities in a falling market and charge you fees for it when they know better. But they're conflicted because the money's too good. The money makes you do things you don't want to do. It's the nature of money. So you get others. By the way, I'm not just picking on St. James's Place. Blue Whale as a pension fund, down 27% in 1 year. 1 year, 20. So ask anybody you're thinking of going to an IFA or a wealth manager, just ask them, how did you do in 2022? My preference is people to learn it themselves. Now, if they don't want to learn it themselves, just use an index tracker like an S&P 500 for the long term, as Warren Buffett suggests. Markets year to date, have we done? Well, the Nasdaq's up 19%. Now, I want to teach you something really important. The S&P is up 15% this year. Okay. Now, last year, the Nasdaq was up 55% and the S&P was up 25%. Now, I want to teach you something really incredibly important. Now, I know I've said it before. Look what actually happened. Went up, then you lost all of it. So you had delight, then despair, then delight again. Okay? That's how it happens. It happens like that. It does not delight, despair, delight. It does not happen in a straight line, which is what people think. And if you happen to get in here, that'll come out in the wash over many years. The fact that you started your investing journey there, you'll start with despair first, then delight. Got it? That's how it works. It is not a straight line. For those people thinking, oh, this is easy, 18%, it's a bank interest account where every month I just get a return, and they go delirious. They're wrong. So what happens with most people is they end up getting out here after they saw the gains whittle away and they despair. So they get out there, and then they see it go up, and then they get FOMO, and they enter here. So they lose all the money there. They lose those gains, and they get wrong steps. So if you're wondering why private investors tend to lose money, it's because they don't know what to do when the markets are falling, and they don't know whether that's a baby bear, a mama bear, or a daddy bear market, which I'll explain those sophisticated terms in a second. Over the past 1 year, the Nasdaq's up 31% from July to July, or end of June rather, to end of June. Okay, and the S&P is up 23%. Again, it did the same thing. Delight, despair, delight, despair, delight. That's how it works. I wish it was a straight line. It isn't. Look at this. For about 5 months, you had a 0% return in a year where you made 31%. In fact, you had a negative return for half the first 5 months, even though you're going to end up making a 31% return. Got it? So when they say don't try and time the market, that's what they mean. Don't try and time all of this. You'll mess it up. We look at a 12-month period and we say when the market's falling, is that a mama bear, daddy bear, or baby bear? And I'll explain what those terms mean. So we just hold through that period. We're not timing it. We just hold. We just go, yeah, fine, whatever, like that as well. We hold through it, not to worry. That's how you capture the gains. But you don't buy and hold forever. There will be times to exit, which I'll explain in a second as well. Once you master those two tiny little things, it's easy. Okay, US valuation. Oh, but the markets are too expensive, Alpesh. Well, valuation is only one thing that moves stocks. Growth is another thing that moves them. Momentum moves them as well. Anyway, when the markets are at the current level of valuation as they are now, they can still be up 20% in the subsequent year. Okay, they can still, this is from JP Morgan, by the way, JP Morgan Asset Management. They can still be up significantly, although most years over the subsequent year, they're not, but they can be. They can be, and that's interesting. I'll come to Tesla. There's a lot of people asking about Tesla as well. I'll come to jd.com as well, and some of the other questions. If I don't answer them now, I will do so shortly. By the way, I'm at the House of Lords hosting this event for the Royal Air Force on the 12th. Do come along. It's a free event, and you can see who you've got to RSVP by. Oh, that was 2 days ago, so you might have missed this now. Well, I'm sure if you still message cecil.soanes at ABPL Group, they might let you in. So the Peers Dining Room, it's a free event at the House of Lords. As I said, I'll be moderating a panel with the Royal Air Force on climate change, very much in the news. Okay, now, secret ways I cheat to beat fund managers. Fund manager idiots like this. Of course, idiots like that are very easy to beat. That's me in the Financial Times winning the competition to forecast the market. So let's go into that and then some of the individual stocks that I like. Now, I've mentioned this before. You can Google Sortino later, but hi, Sortino, just so you know, it's a good way of cheating if you want to win the markets. What you do, what you're looking at is stocks, i.e. companies, which are selections of individuals, companies which have got a consistently high average return and very little downside volatility, downside risk of missing that. In other words, they keep scoring goals every game and they hardly ever get no goals. All right. Put another way, they score a lot of average runs and hardly ever score low runs. They're consistent, right? That's what Sortino measures. Well, I cheat. I just look for companies with high Sortinos because that's what you actually want in your portfolio, don't you? High returns, but consistency, i.e. very little risk of missing it. You don't want something which is a one-hit wonder, which might produce a high return, but every other year is rubbish. High alpha. In other words, if the market goes up, they go up more. If the market falls, they still do better than the market. Now, there's no guarantee they'll continue doing that in the future, but it's a bloody good box you want to tick, isn't it? Isn't it? The past isn't a guarantee of the future, but it is a bloody good guide. Okay? It is a guide, isn't it? Okay. For Sortino, what time period do you use? 1 year. No point using 50 years. No point using 5 minutes. So 1 year is a good balance. Go to cash in years like 2022. Monthly MACD drops below its moving average. Simple. Few good companies. I do not spray and pray. I follow and cheat using the Warren Buffett approach, which is I'll have most of my money in about 15 to 20 companies. Okay, that's it. That's it. And that's what I do. I also stole and cheated by taking from Goldman Sachs, and I'll show you the slide later, their 30% per annum formula, and from Nobel Prize winners, Famer, Kahneman, and Thaler. I can talk about that later on, which I've published their stuff in my books. And I'm just going to reset that poll. I'll make sure the books are available right now. Where is it? Share. Okay, so you should be able to see the book. If you're on the webinar, you won't be on TikTok. To get the book from TikTok for free, alpeshpatel.com/links. Now, never hold forever, as I've already explained, so I don't need to do that. Now, let me go on to this then. Exit if gains start to decline. That's important. Now, it's easy for me to do that. So if the gains start dropping, you don't just hold and sit there. So you have some kind of exit strategy. For instance, if it drops X%, I will sell Y%. Simple as that. You don't just say, no matter what it drops, I'll just hold it forever. Okay, it's as simple as that. And you've got to know when it's a baby bear, and I'll come to that as well. Ignore stories and narratives. I follow the data. Now, I stole that from Jim Simons, probably the most successful fund manager in history. He passed away recently, started investing at 40, ended up with a $100 billion fortune, and delivered 39% per annum on average every single year. Jim Simons, just recently passed away. That's his approach. Basically data, not narratives. Bespoke, you make it bespoke to you. Not a pooled vehicle where you're joining everybody else and saying, oh, well, I'll just join what they're buying. That's a bit stupid. I need to know what stocks I own, and I look at the data to determine them. Okay, that's how you cheat as well. Managed by me, not some kind of committee. pick bespoke based on historic drawdown. So I'll look at the historic drawdown of any particular stock by just pulling up the charts on something free like a trading view. So once I've got the data, I just look at that and say, well, how much has it fallen in previous upward trends? If it's more than I'd like, then I won't do it. And I'm going to show you that with individual stocks in just a second. By the way, S&P 500, on average, the first half of July is the best period of the year. It's not me saying it, it's just the data. First half of July, what we're in now, right up to my birthday, right? It's a little birthday present the stock market's given me every year since I was born, is the best period of the year for the S&P. It just is. Sorry, don't blame me. It's not my fault, but that's just how it is. Okay, so I want to make that point also about how stock prices move. I really want to teach you this. This is incredibly important. This is Microsoft. This is a year in which Microsoft went up 59%. Can you see that? Went up 59%, okay, in 1 year. However, look at that. So look at point number one. It says 59%, okay? Now look at point number two. It had a 4-month period where it produced a 0% return. So wait a minute, it went up 60% in a year and you got 0% for 4 months. A third of that time was spent getting nothing. Yes. So for those who think, oh, it'll just go up, and guess how many people would have sold their Microsoft because it went up 0 over 4 months. Then look at point number three. It actually spent 2 months dropping 8%. Hang on, 4 months nothing, 2 months dropping. So 6 months, half that time was spent getting under 0% return. And yet you delivered a 60%? What, Alpesh? How the hell does that work? Yeah. Perverse, isn't it? And I think, if anything, take a picture of that and just put it up on your wall so you know. It is incredible that that can happen. And people just don't get it. That's actually what happens with the Microsoft. And that's why they go, oh, I'm frustrated now. I haven't got any. It's because they haven't got perspective. They don't know history. But also because they don't know how to read that, they don't have to rely on hope. We'll just look at that and say, well, actually, any falls were baby bears. We can ignore them. Okay? So we're going to come to that. What the hell's a baby bear? By the way, if you look at my YouTube channel, you'll see a whole load of more videos on why your pension fund manager or your IFA should be locked up. Now, as I've mentioned, I'm going to go through this. When I pick the individual stocks that I like, I need value, growth, income, all ticked. I need cash flow, Croaky, which comes from Goldman Sachs Wealth Management. I cheat by using Sortino and Alpha, which I've just explained to you. And momentum comes from the hedge fund industry as well. Now, we're going to go through those and see which stocks I like the look of. Okay? And there's Jim Simons. And it's what he said. Now, his medallion fund earned $100 billion between 1988 and 2018, 39% after fees. The guy's a legend, and I love what he said. I have no opinions on any stocks. The computer has its opinions, and we slavishly follow them. I have exactly the same attitude. I didn't cheat by copying him. It was just coincidence he and I came up with the same idea. The big difference between me and him, I've got 3 strands more hair, and he's got 100 billion more than me. Okay, so there we go. Now, although I'm sure he'd swap the hair for the 100 billion. Now, here we go with this. This is incredibly important to understand all the slides I'm going to show you about what's happening with the market at the moment and how I stay calm, cool, and collected about whether there's any falls or whatever else, which is this. You can see 3 things, 1, 2, and 3. Now, the head of the Federal Reserve once said that we want a Goldilocks economy, which means not too hot, not too cold. Well, I've taken the same analogy because if the Federal Reserve are going to use it, and I've got a master's degree in economics, so I feel I can use such complicated terms as Goldilocks analogies, then a baby bear, i.e. falls like this, 0.3, baby bears are where the monthly MACD is rising and you can ignore them. Mama bear is where stocks are falling or whatever is falling, but the monthly MACD is falling as well. Now, in that case, you can either ignore it if you're risk loving, or if you're risk averse, you might sell some, but not all your position. The big possibility is mummies can transition into daddies. Okay. As in the real world, so in the market. And if they transition into daddies, which is the MACD is falling, but this time below its own moving average, then you probably want to be in cash. Most times you want to turn into cash, which is 2022. So baby bears can be ignored. Mama bears can usually be ignored as well, unless you're risk averse, in which case take some profits. Daddy bears you do not ignore. You usually go into cash. When daddy bear's in the house, get the hell out. Daddy bear is monthly MACD falling below moving average. Mama, monthly moving MACD falling. Baby, monthly is rising. That's it. Simple. Okay, we're going to keep it that simple. Simplicity is good because simplicity gets done. And also, I've written about it in my books, and I've given you, I think if you're on the webinar, you can see a downloadable copy of the book for free. It's explained in there as well. And if you want to download a free copy of that, alpeshpatel.com/links, you'll be able to get it there as well. Now, S&P 500. How are we? Let's look at the markets. I'm very happy to be investing right now. Why? Because the monthly momentum is going upwards, although I am well aware that it is getting more and more overbought, and therefore it's becoming increasingly like 2021, which is, there's still more upside, but let's be careful about now. Remember this term, write this down. Drawdown danger is depth times duration. What the hell does that mean? Well, we keep calm because drawdown, peak to trough. See that? That's peak to trough drawdown in an upward trend. So that's an upward trend. Drawdown danger is that drop and the duration before you break even. Now, if you don't like that, you should expect it. But if you don't like it, you shouldn't even be in the stock market. And as you can see, it's a baby bear because the MACD is just rising all the way through. So you could have ignored it. So when those drops happen, somebody like me goes, yeah, not bothered. Right, thank you. Everyone's like panicking. It's like the Rudyard Kipling poem. If you can keep your head while all around you are losing theirs. They're all losing it. I'm going, no. Monthly MACD is rising. It's a baby bear. I'm not bothered. Relaxed. I don't even look at the news. Just like Warren Buffett, I don't stare at CNBC every single day, contrary to what people think. When I did my show on Bloomberg TV, we would, of course, be in the studio talking about all of this every day. NASDAQ 100. Fine. It's a bit overbought, and you just look at the pattern over here. So there might be a limited room, and we know there'll be some drawdown depth times duration, drawdown depth times duration, very important for you to understand and know. If you don't like the depth and duration of the drawdowns, then you should not be in that instrument because you can assume they're going to happen again. Okay, and that's rising just like the monthly MACD did. What is the MACD? It's basically an indicator of short and longer term average prices. It's just looking at the average price. If average prices in the short term and the long term are rising, then it's suggesting there's more upside momentum. That's it. That's the NASDAQ 100. Right, let's move on to more. That's the FTSE 100. It seems to have fallen off a bit. I suspect after tomorrow's election results, because there'll be some certainty, unless there's an absolute coalition government, unless it's like February 1974, which you will all remember was a coalition government, Lib Lab, and then there was another election in November. Failing that, it should actually probably rally, because the old saying is, well, sell the rumor, buy the fact. So that's what should happen, especially because this is still rising. Anyway, we shall see. So I suspect tomorrow we'll get quite a bit of a bump up in the FTSE 100, unless, like I said, some kind of coalition happens. Okay. Let's share another poll. Put this into the chat box if you're on TikTok. Will the Dow be up by end of 2024 from today's levels? Okay. Also, you can put in the chat box who you think is going to win the general election in the UK and the US. Top 10 S&P stocks over the past month. We're going to go through all of these to see if we're missing any action. Should we be in any of these? Is there something we're missing where there's money to be made? I mean, who wouldn't want to make a few double-digit percentage points in such a short space of time? We all would. So let's have a look at that. Tesla, first one up. Okay, so what's going on? Now, as you can see, it looks like I'm going to zoom in, the monthly MACD, which is the blue dotted line, has stopped falling. So this would be eligible for a special situation if it met our value growth income of 789. All right. Now, I said in previous months, it probably has bottomed, but until it does what it's meant to, which is this starts rising, I'm not going to get in. So that would now be eligible subject to hitting my value growth income of 789, which I've not looked at. And if it is, then that's fine to get in. And it's certainly dropped broken out from the downward trend. So where might that go? Well, it I guess the obvious point is it's going to go to those points there. It's going to go back to its all-time highs. That seems the most likely thing with Tesla in the near term. Okay. By the way, you might want to see seasonality. In July, it tends to have one of its best months and is more likely to be up than down. August, not so much likely to be up, but is going to have a positive average return. So not too bad. May really takes the wind out of it, I guess. October, when we got out, is when it got screwed, September and October. Adobe has, of course, bottomed out. Now, this is an instructive one because if you look at that drop of 31%, you might think, oh, what's going on? And you have a heart attack. But then you look at previous upward trends. And this is a really important point. If you're picking stocks, I'm going to teach you something, again, incredibly important. Look at previous upward trends. You can get these charts for free on TradingView. For free. Yeah, I said for free. Okay. I'm not here to promote them. I don't have any relationship with them. And you can see that these kinds of falls in an upward trend from peak to trough are common, but so are the reactions or rebounds. Okay, 23%. So 30% shouldn't have really surprised us too much, and then it's in that direction. And did it cross just below its moving average? It sort of became a daddy bear, but not for long, and it's moved back up, and now it looks like it's going to continue upwards. Maybe they've got their act in order at last. Broadcom, it's an 8 on my value growth income, so it meets that criteria, but it's overbought. Now, you might say, well, I'm going to overrule you, Alpesh. I'm just going to buy into Broadcom. I don't care that it's overbought. It's not one for you because it's more risk. So it's a great company. Look, value growth income ticks all the boxes. I just tend to stay away from companies there. Now, if you already own it, you'd continue holding it unless it drops X, then you'll sell Y. Now, this is why Americans get rich. You start off with 528 and you've tripled your money. You've tripled your money. Some little old lady in Florida is saying to herself that since the last 18 months, she'll say, well, my husband left me $1 million and I'm now at 3 million. So I think I'm done. And I just did it in Broadcom. That'll be it. Okay. And they have a lot more choice of these. That's why I look at American companies. My first column in the Financial Times, I was selling all my UK stocks to buy US ones. That was 1999. Why did I say that? Not because I foresaw anything on AI or anything, but just because I had more choice to pick from, more of these types of companies. That's why. Okay. Oh, God. I'll have to read all of that a little bit later. Is there a way to view seasonality and banks that are buying for free? Oh, you mean this? No, sadly, that bit's from TrendSpider. What you see on screen is TrendSpider. And that's not free, unfortunately, which is why I sent you to TradingView. So I'm afraid it is. I'm not aware of anything for free. But if some other people have it, then please do share, because actually a lot of the stuff I learn on which sites are good is from retail clients who will tell me on my webinars, oh, this is good, that's good. So if you've got any favorite websites, do let me know, any of you as well. CrowdStrike was one of the big movers. Now, again, you see that massive upward trend there. Great. But this is a bit overbought. So that's what concerns me. And also, it doesn't hit my value growth income either, just so you know. Oracle does hit value growth income. Great company, but overbought, which is what scares me. So not one for me, I'm afraid, even though I know it's a wonderful company and all the rest of it, but I shall look elsewhere. Okay. Corvo, 7 out of 10. And that seems fine. But you might not want it because you might say, well, hang on, in an upward trend, look at how volatile it is. Not for me. And my rule is, if in doubt, leave it out. If it's not for you, you don't like the ride, then just leave it. Don't panic and think, I have to get it. The problem with most people is they go and do it because they're panicked. ServiceNow we've had in the past. It's wonderful when it gives us gains. 7, so that's all fine, but it's overbought. So it's not one for me at the moment. In future, I'm sure it will be. There's a bit of overhead resistance, but it does meet my value growth income. Remember, those are these factors. Those are these factors, value growth income, which is my proprietary Excel, cash return on capital invested, and so on. But I need them all to be green. And just to show you how stringent I am and how happy I am to reject people, none of these companies that I'm showing you on screen meet my criteria. Why? Because they're not all green: value, growth, income. Now, does that mean they can't go up? Of course not. They might go up for other reasons. Maybe Donald Trump does a tweet about them and they go up. Or well, he doesn't do tweets anymore, does he? He's banned. He does a truth social thingamajiggy. Or I don't know, puts a tattoo on his arm about them. Or Musk does a X on them. Whatever it is, those aren't the reasons I'd want it in my pension or my son's junior ISA. Incidentally, what is in my son's junior ISA? It remains 2 times leverage, Apple, Alphabet, Amazon, and Microsoft for now. And same with my wife. For administrative reasons, I keep her SIP the same as my son's junior ISA. He's 6. She is 11 years younger than me. Yes, I am very lucky. Now, ServiceNow. So overbought, not for me. Thank you very much. Arista Networks also done incredibly well. Again, that little old lady in Florida is going to us. She goes, it's gone from 100 to, what is that? 357, Sonny. I've gone from 1 million to 3.5 million in just 18 months from what my husband left me. That's what happens. That's why Americans are rich. They get a lot of these companies. Have you even heard of it? Probably not. Okay. Well, that little old lady just made 1 million into 3.5 million. Does tick the box there, but it's overbought. Now, you might say, well, hang on, Alpesh, bloody hell, it might be overbought, mate, but it keeps rising. So let me tell you something. 20% of the time, when this is like this, it just keeps going up. 80% of the time, it tends to fall back. However, here's something for you. You might take the risk. You might say, no, I don't care. I'm getting in. Well, remember the rule. If it drops X, sell Y. It's as simple as that. If it drops, say, 10%, you decide on your risk appetite. Do you want to sell any? Do you want to sell 10%, 20, 30, 40, 50, 60, 70, 80, 90, 100, depending on your risk appetite? If it drops 20%, what do you want to do? If it drops 25, what do you want to do? If it drops 30, what do you want to do? Now, don't say I'm not going to sell any unless it drops 90%. That's no risk appetite. Basically, you should have numbers up to it dropping 25%. And then you pick how much you're going to sell based on your risk appetite. Yes, I know the banks like it. I don't care. I've written in my articles, and academic research shows the banks are over-optimistic and they're invariably wrong. Seasonality is just chance, fooled by randomness. Do not be fooled into thinking, oh, that's always going to repeat itself. It's like coin tossing. But this isn't. That tends to suggest not a guarantee of upward movements, but an increased probability of it. So whilst this isn't for me, it is a momentum play. It does meet our criteria. And were you to do it, all you do is keep to my exit rules, which is if it drops X, sell Y. So if it drops 25% from the peak since you bought it, you might sell all of it based on your risk appetite. Why your risk appetite? Well, because neither you or I have a time machine or crystal ball to be able to see into the future of what's actually going to happen. So given that we can't have the perfect exit, which is the foolish thing people look for, idiots, what you should be doing instead is saying, well, I'll base it on my own risk appetite. If it drops X, I'll sell Y. Simple as that. Hewlett-Packard, not for me. Overbought, even though value growth income is fine. Partly because, look, it's just a bloody mess. It just keeps doing this. And I don't like companies that do that. And they say, well, hang on, Alpesh, that's not very sophisticated. You don't like stock prices which go like this. Yeah, it's not good for my stomach. Okay. Don't have to buy it. Warren Buffett has a ton of cash sitting on the sidelines. He goes, no, I don't like it. I'm going to buy it. Costco doesn't meet my value growth income, even though it has been, for this past month, one of the best performers because it's a bit overbought. Now, you might say, I don't care. I'm going to keep buying them. I'm going to buy these overbought ones because all these banks love it, and it tends to have really good returns. Yes, you're absolutely right. So be it. Fine. Exit rules on leverage are exactly the same. You look at the underlying, and then you exit based on the underlying. Simple as that. But you better have a strong stomach if you're leveraging. Apple. Okay, there we go. Well, you know my view on Apple if you're on the Great Investments Program, so I won't discuss it here because and Amazon, you know, if you're on the Great Investments Program, what I've got, how much I've got in 2 times leverage, how much in the underlying. Microsoft, similarly, you'll know. Meta, you'll know my position on that. Okay, YouTube, I've mentioned. Bank of America, I don't own, but I'm showing this to show you just the stock market update. Financials are cheap and it's been continuing upwards and probably will be. I don't own it because I can't own everything. Okay. Would I buy it today? Well, no, because I'm fully invested in all the other stocks that I've got. Can't you muster up some money from somewhere, Alpesh? Well, probably, but I'm pretty relaxed. Netflix, I don't have, you will know, and I've been following it since those results here. And it's to show you a couple of things, just how easy actually investing in American companies often can be. So the results came out. I started following it after those results. I didn't buy it. because I can't buy everything. And that's what it's done since. And I said to you back then, look, the monthly moving average is going up. And of course, since then, it's gone up from 400 to nearly 700. So what is that? Nearly doubled. Pretty straightforward, isn't it? Okay, and if it drops X, you'll sell Y. So these falls you don't worry about because you can work out whether or not they're baby bears or mama bears, and that's it. Not really much to do. Walmart, again, it meets my value growth income criteria, but it's a bit overbought. So if you wanted to, it's up to you, but make sure you have the exit criteria in place. Not for me, because I don't like overbought companies. And you might say, you're going to regret that, Alpesh, not having it. Well, thank you, but the portfolio I've got at the moment is doing rather well. Tesla, I've discussed already. Berkshire, overbought. Warren Buffett's investment vehicle. Eli Lilly. Ooh, look at that. Overbought. But you might say, no, I don't care if it's overbought. I want in because look at that trend. And yes, the little old lady from Florida is saying, well, my husband got this in January 2020 when it was 150. Now it's at 1,000. So, yeah, well, at 900. So I've nearly made eightfold on my money. My $1 million he left me is now 8 million in 4 years. 4.5 years. 8 million, from 1 million to 8 million in 4.5 years. Eli Lilly, household name. Okay, I'm sure some of you take its drugs or other drugs, but look at that. Now, nothing to do with me. I didn't create the company. I didn't get in when the little old lady from Florida did. What I'm saying to you is it's overbought at the moment for me, so be it. I'm making enough money on the other companies. But thankfully, there were other companies, and enough of them that even if I miss that, it's okay. There were others. Walt Disney, Baby Bear, so the falls don't matter. Block, if you're into that. Baby Bear, so the falls don't matter. Columbus McKinnon. Now, this is an interesting one. Again, to show you, look, if you've got something which in an upward trend moves up and then down 27, up, then down 27, then up, then you might say, well, that I don't want to stomach that. I don't want it. Simple. Then stay clear. Something sometimes people often miss. They forget to look at the history of the price and the characteristic and nature of the company. And companies are collections of individuals. I mean, would you hire somebody who's erratic? No. So if you find something that's erratic, then don't buy it. It's not as if it's suddenly going to change its ways. Now, on LinkedIn, you will find Mr. Alpesh Patel. Do follow me on there. Do look at my campaign for 1 million as well. What I want to do now, there's a lot of free resources there, including my books. Now, what I want to do now is also tell you, will the Dow be up by the end of 2024? 66% say from the moment now to the end of the year, yes, they believe it is. So well done, you lot. Because I'm sure you're probably right. Who will win the US election, Biden or Trump? I'm going to suggest that as well. Okay, I'll answer the other questions just 1 second. Will, are there different exit rules? Well, if you do, I want to exit 100% if it drops 10%, then you're very risk averse. And the risk of that is you get out prematurely. Okay, so there's pros and cons of having any of those. And it's up to you because you might look at it historically and say, oh, it's actually very rare for it to drop more than 10%. So if it does, that's not just noise. I'll get out. Now, let's look at some of the biggest mistakes investors make. 1, not doing obvious research. You need companies which are undervalued, for which you can look at, say, the price earnings or the price earnings growth ratio. Warren Buffett looks at price to book, PB. Okay, my favorite is price earnings because of the academic literature I've looked at, it's adequate enough. Okay, valuation is twice as important as growth, according to academic research, in terms of what moves stock prices. Growth, you want sales growth, profit growth. Profits and earnings mean the same thing. Sales and revenues mean the same thing. Okay, and you want cash flow growth. Growth is half as important as valuation, according to academic research, and income dividend yields are half as important, again, as growth. But you need to tick those boxes. If you say, I'm only going to look at value companies or growth companies or income companies, as fund managers try to get you to do because they want to sell you multiple products, then you are flying blind. You are gambling. Whenever you don't tick all the boxes, you are leaving room for chance and hope, which means you're gambling. Okay? And to reduce the chances of gambling or speculating, you need to tick all the boxes. Now, momentum, it's a hell of a lot easier buying into a trend than against it, because trends tend to persist according to the data. Not guaranteed to, but according to research from AHL, Winton Group, who else? Citibank, they tend to persist. Actually, most trend-following hedge fund managers. In fact, Trends persist to a sufficient extent that John W. Henry can afford to buy Liverpool Football Club. He's a trend-following hedge fund manager. That's how much they persist. That's how much easier. So we look at momentum and the direction. And also the most important statistical things which help me cheat, Sortino and Alpha. Volatility below 20%, ideally for me, because I don't like stomach-churning returns. Now, the other big mistake, not knowing when to hold and when to sell. I've told you, baby bear, you hold. Mama bear, if you're risk-loving, you hold. Daddy bear, you get the hell out of there if daddy's in the house. Got it? Mummies can transition into daddies. So be careful, right? Paralysis through analysis. But Matthew, will you email me about JD.com if I don't have time to cover it here? Okay. If you're on the program, just let me know. Because you can just email me anytime about any stocks. Not understanding big winners make up for losers and winners take 12 months. Now, this is a major problem. I've shown you Microsoft for many months in a 12-month period where it went up 60%, didn't actually generate any returns. So what does that mean? Well, it means that people don't realize that in any portfolio of, say, 15 stocks, you will have a bundle which go up a lot. You'll have a bunch which go up and down maybe a little, and some which get stopped out. And it's these which go up a lot that make up for it. Well, why can't they all be like the big gainers? Well, I wish, because that means you'd have 200% returns, 137. How come you don't just buy one stock, which you know is going to go up 200%? Well, because you don't know. You don't have a time machine. And this is the bit that people don't realize. So when in 2020 to 2021, we get a 54% return in 12 months, that's not because we knew which ones were going to go up, because if we did, we would have made 208%. Some went down that year, but the ones which went up brought the average up. So if you've got 20 stocks, you have 5% in each. Okay, not having an exit plan. If it drops X, sell Y. Or another rule can be if it drops 25% from the high point since you bought it. And that 25 can increase to 30 or 35 if consistently the stock drops that much in an upward trend historically. Okay. Mistakes looking at too few stocks. There's your fund manager from St. James's Place. He's looking for stocks. That's how they do stock picking. Their fund managers at St. James's, looking at too few stocks. So they might just look at UK companies or UK growth companies because that's what they've been told to flog. And if they've been told to sell something, you better believe they're going to sell that crap. So they'll say, I'm only going to look at a certain geography and a certain style, and that's it, nothing else. Well, that means you're picking from a small gene pool, so you're unlikely to be able to find good companies because look at how many I have to reject. I reject all of these because they don't tick every single box. They don't tick every single box. I'm not going to put it in my pension. Hey, it's my pension. It's my son's inheritance. It's my wife's, I was going to say alimony for a minute. Alimony or inheritance after she kills me. But whatever it is, I'm going to make sure that I look at every single criteria because I don't like gambling. So, whoops, I moved quite a few ahead. And they'll rob you blind. This is from an actual fund. Okay, you're paying 10%. They'll tell you to hold for 5 years because school fees are going to have VAT added. So they really need you to hold for 5 years now. And on a £10,000 investment, that means they're going to take £1,000 off you. That's 10%. They're charging you 10% over 5 years. Oh, but Alpesh, no, mine says 0.75%, 0.5%. They're lying. They're lying. Look at the small print. Look at page 37 of the form. Ask the IFA and the fund managers, give me your total fees, and I want to see page 37. It's always on page 37. And it'll be buried in there. It's 10% you're paying over 5 years. Tell them to give you the 5-year figure. Okay? It'll be 10%. That's what you're paying, believe it or not. Yep. Amazing. Average return each year, they'll tell you, we'll do a bit better than a bank account. And many of you are happy with a bit better than a bank account because you don't have the American spirit of the little old lady from Florida who actually just wants to get rich and not just do better than a bank account. It's a very British way. I mean, money, after all, is the most distasteful thing. And nobody would want to be rich. It'd be just crass. We leave that to the Americans, which is fine, in which case, put your money in a bank account. Okay? Now, going back to being a bit more American about it and wanting to make money, this poor lady had emailed me in December. My own pension, private, legal, and general. This is private my employer. Please, rule number one, if you've got an employer pension, please ask HR to send you all the details of it and read the forms. Where's them? Where's your money? Your money, because you earned it. Okay, I don't want to be a socialist about it, but you're the worker. You earned it. She got 20% growth over 10 years. 20%, not per annum, in total. In total. Okay, been following your weekly broadcast. I invested very limited funds, but seen returns of 20% in 1 year. Yes, small amendments going to make big changes. They're ripping you off. You're paying for their children's private school fees. And the reason they're not sweating it is because they know there's enough of you out there that they can absorb the VAT increase in school fees. Is 40% realistic? Only if you get tailwinds in the market. So if I continue, the next 7 years are like the last 7 years, then I will get some 40% years. I'll also get years like 2022 where I'm holding cash. Okay. High Sortino, high alpha stocks. I'm afraid it's a bit of a must most of the time. You can rely on momentum sometimes, but you certainly need value growth income, i.e. undervalued companies which are growing with dividend yields to be 7, 8, 9, or 10, as I said. Okay, they tend not to be emerging market companies unless you really like playing Russian roulette and taking massive risks. Okay, if you want to do that, go play with emerging markets. If your IFA has told you to go play with emerging markets, the guy's a bloody idiot, because he has the option of the most developed, richest country in the world and tells you to go and shove it into some Vietnamese fund because he gets big kickbacks. Ask him, how much are you getting paid in kickbacks for shoving me into Vietnamese stocks, mate? Okay, they will sell you. If you can go to cash in bad years like 2022, remember I told you the rule and how you do that. If you monitor once a fortnight, because you want to see if any's dropped 25%, okay, or if it drops XLY. So it's a little bit of work you've got to do rather than outsourcing all of it. But I'd rather do that to get my NASDAQ 55% return in my pension in a year. If good years make up for bad, so bad year 2022, good year 2023, okay? That's the only way you can do it. If there's no more good years ever again, we're never going to make money ever again. Croaky, that's the Goldman Sachs version, 30% per annum. I'll come to that and show you the slide in a second. 12 months, and then you reevaluate, do it all again, and pick a fresh bunch of stocks. They might continue being the ones you already have because there's no reason to exit them, like an NVIDIA. But if not, you buy a fresh bunch after 12 months because you've sucked the marrow dry. There's nothing left. You've gone, and there's no more juice left in the coconut. If you sell anything which drops, so you've got to have some kind of exit. You can't do a meta and just watch it drop, okay? And if you do all of that, then this is what happened to us last year, which was an exceptional year, which will never happen again. Let's just assume we'll never get the returns we got last year again, okay? Let's just assume that, will you? Because that's what happened following that. Following our process, okay? It was 80%. Now, the good news is, once you get that occasional good year, and there's wild swings, 2022, 0%, 2023, 80. So let's say we never get a good, decent return beyond just bank interest ever again. At least we're compounding on a year after we got 80%. So we went from here, we went from sort of here to here, higher up, okay? Better returns. And even then, same process, value growth income, you end up with that. Why at the end of the year are there so many gaps like all of this? Well, because by the end of the year, and this is why you look at it after 12 months and reevaluate, so many of the companies wouldn't be eligible to stay in there anymore. Not least because they might now have got overvalued because they went up, whatever, 50%, 40%, and so on. Now, these are little subtle things people don't understand. And by the way, all the money didn't come from just the NVIDIAs and Metas. Look, Sterling, okay, ServiceNow, companies, MedPace. Had you heard of them? I hadn't, actually, before I bought them, none of those. So if you're going to hold over 10 years, what's a plan? What's a good plan? Well, let's say the S&P over the last 10 years has delivered 15% per annum in sterling terms, 15% per annum in sterling terms. So that's the index. Let's say you do a little bit better by cherry picking and you go to 20. Well, 100K, and given that you're going to add some money each month in savings anyway, should turn into $1 million over 10 years. What does that look like? That's your 100K. That's the money you've added here, and that turns into $1 million. It doesn't work like that as simply, because what happens is it goes up, down, up, down, up, down, up, down, up, down. And the idea is that in the 9th year, your money is working hard enough that it's giving you an income of over 100 grand a year. So you retire, okay? Because it's just generating that much capital. And that's more than enough for what you need. Obviously, you'd make precise calculations yourself on what you need and what would happen if you withdrew it. This is basically saying there are 3 ways to make money and to get rich. 1, you get a time machine and you start earlier and save sooner. 2, you save more. Well, if you want to do that, cut out all your enjoyments in life and just save more. Or 3, you improve performance. And small changes in improving performance produce substantially larger results. Maths. Okay? If you're not good at maths, Small performance changes make massive returns. It's a hell of a lot easier than saving more or buying a time machine. And I believe private investors can be better than these kinds of guys. By the way, 80% of you think Trump's going to win. I wonder how many of you think Farage is going to be prime minister in 2029. Okay, that'll be interesting to see. Let's just go back to the IFAs and the problems there. So that was 2004. Me with my big mouth. The Financial Times said, okay, well, if you think you're so good, Mr. Smarty Pants, why don't you go up against people who are amazing, like Neil Woodford? Okay, fine. But I said, if you do it, then when I win, and I will, you put me on the front cover of your business section and you proclaim it. And they also gave me a bottle of champagne, which, given I'm teetotal, was a waste. I said, keep it. And then, of course, his poor performance continued. Fund managers are handicapped in many different ways. A significant way in which they're handicapped is they can't go into cash. And of course, they have so many conflicts, let alone greed, that they end up just shooting themselves in the foot because you're happy to keep paying them. Don't do it. Either do an index tracker or learn to do a bit yourself. Now, on the whole, I have 20 stocks, as I've already mentioned. Okay, I keep to 20 stocks on the whole. All right. That was my book launch. And I put the money equally into those. But if it's Meta, Microsoft, Apple, Amazon, Alphabet, I might put a bit more into that. I also have some 2 times leverage for my son because his junior ISA can only have less money in it. So we use leverage. So instead of whatever it is, 12,500, because he's got 2 times leverage, the equivalent each year of him having 25,000. I don't do more than 2 times leverage for him because I love him and don't want to blow up. I've talked about, in my various books, I've talked about these things. Okay, so you'll have seen this elsewhere in many, many different places. Okay, that's the Goldman Sachs slide that I took from a lunch after I set up the hedge fund in 2004. Took this to the lunch. And basically, cash return on capital invested, what they discovered is 30% per annum of your returns. 30% per annum of your returns. This is why, if you've got 50 million, go to Goldman Sachs Wealth Management. They'll do this for you. This is from the Goldman Sachs research department and their quantum database. I stole it. I copied it. Everything I've said to you today, I've pretty much copied from different sources. Okay, either Nobel Prize winning economists, Goldman Sachs, or world-renowned hedge funds like Renaissance Technologies, AHL, or whatever. I've just stolen stuff from all of them. That's it. Next to nothing. The only thing that's original about what I've said is the way in which I've arranged it and put it together for myself. That's the only thing that's original. Everything else, I've just stolen the ideas from everybody else, including some of the world's leading traders who I've written about in my book, Mind of a Trader. So if you read all my books, you can redo exactly what I've told you in this webinar and give this webinar. Now, this I stole from Goldman Sachs because I knew I had to tick that box because cash return on capital invested, croaky, had to be in the top quartile. Companies in the top 25% by cash flow from the capital they invest in the business generate 30% per annum returns. Not every year, as you can see, and not every company in that basket. Not every year, not every company in that basket. But I knew I had to tick that box. Not the only box I'm going to tick, because I'm going to wear belt, braces, another set of braces, actually 3 more sets of braces, and 15 sets of belts. Got it? Okay, but the point is, I needed to tick that box after I saw this. How could I not? How could I not? Now, Goldman Sachs, there's a reason they have an R&D department, because all companies do. 1. 2, think about it. If they weren't generating 30% per annum for their wealthiest clients, their clients are going to go to JP Morgan, who are going to say, well, our R&D department can do the same and generate the same. Okay, so that's obvious. If they said, oh, yeah, we can do 12. Well, you're not going to become Goldman Sachs Wealth Management, are you, for the richest billionaires in the world for very long? So it only occurred to me after the event. Of course, it makes sense. They've got an R&D department, and their job is to find new ways of making money. And that was it. Anyway, I took this. I say I stole the slide. They didn't. They let us take the presentation with us because you know what? They rightly worked out. What is this going to put us out of business? No, it's not. If anything, it's probably going to advertise it more for them, and they'll get more clients. Not that they need them. They don't need me, and I'm not a threat to them. Now, croaky was actually invented by Deutsche Bank, and Goldman Sachs stole it. But it's not the only factor you would use. You do value growth income. Now, this is a typical crap portfolio from somebody before they joined me. And they sent me this. And look at the gaps in the companies. Look at all these gaps. Not enough greens. Too many funds. A lot of funds which are overlapping others. Each one of those funds will probably have about 50 stocks in them. So you've probably got somebody who's got 500 companies in there. Very poor alphas, very poor sortinos, very poor momentum as well. Pretty shocking. And then they're wondering why they're getting poor return. And that's what the IFA created for them. So that's typical. Other brokers who've let people down that I've got emails from, Bruin Dolphin, stocks spread over 1,000 different companies in a scattergun effect because they've had it in portfolios, and those funds have lots of stocks in them. Spray and pray. That's what fund managers do. How come, if it's so effective, Warren Buffett doesn't do that? How come, and Bill Gates, how come all their money is in their top 5 holdings? More than half of their money is in their top 5 holdings. I'm going to show you something now, what my plans are, okay, is I decided that actually it'd be good to float a company on the stock market and to remove St. James's Place. These are people who've worked for me. These are my former employees. Naomi now moved to Newton straight after working for me for 2 years, and then she moved to Polar Capital. Kirsty went on to become a pension solicitor. Susan is global head of communications at Wells Fargo Bank, and Kanira is in the venture capital industry after working on our private equity funds and venture capital funds. Sorry, I didn't do the interviews for any of those in my company. So in case you're wondering, are you just sexist against men? Do you just hate men? No. Where's your gender balance? Sorry, I didn't do the hiring. But they're exceptional women. And the point is, you can teach investing to anyone. You can teach investing to anyone. Well, not least because Naomi now, after being my assistant for 2 years, now manages about 10 billion or something ridiculously large at Polar. Okay. Can you hold my hand for me? No, got too much to do. People say, I'm a pensioner. You know, these are most people who ask me questions. Can you do it for me? No, I want you to either do it yourself or do an index tracker. And it is easy to do yourself because you can teach anybody. You give them 2 things. You give them the data and you give them one-to-one tutorials for life, if they want them for life, like a driving instructor. You teach them to drive by one-to-one tutorials, okay? And you give them the data for life. And then that's it. That's all you need. So you give them the car and you give them the driving instructor. I'm the driving instructor and I give you the car. That's my job. Now, what I want to do is float this company and take over St. James's Place and remove it from the market, because I want to give people the data and the know-how so they do it themselves and they manage their own capital instead of giving it to somebody else and paying fees for life. I don't want fees for life because it's a conflict of interest. As soon as you're paying somebody to do it, they've got a conflict of interest to keep you invested even when you should be holding cash. I don't want that conflict. Conflicts is what will lead to you getting underperformance. I want you to be empowered to do it. The only way you can empower somebody is give them data and give them one-to-one tutorials, driving lessons to do it. It's that simple. You can teach anyone. When I talk about this on the BBC with Sally on investing, this is my approach. So now you know. It's well documented in the books as well. I've asked you all in this, what annoys you the most about IFAs? 72% have said underperformance. After that, 9% not trustworthy, lack of transparency. Way ahead is underperformance. And you've seen the performance from the companies. I don't perform, just so you know. I ride the coattails of companies that perform. That's it. I didn't invent those companies. Okay, I didn't invent NVIDIA. I didn't invent them. But what I did do, and I might miss an Eli Lilly because there's too much to look at. You're looking everywhere. You're a kid in a sweet shop. So what we decided when we got all these compliments is actually we want to go ahead with this and make it bigger and bigger and bigger. Get maybe venture capital funding into it and then launch it on the market. I'll show you how you can access the data in just 1 second. Then we trialed it on a group of individuals and we took videos. It's on alpeshpatelreviews.com if you want to see the video reviews, alpeshpatelreviews.com. If you want the data and you want to be part of the program, I was going to cap it at 250. I might go to 300 or even 350 because actually people are learning and picking it up quickly, and then I've got more time than I thought. I thought after 250 people, I just won't be able to go. Then what I want to do is go global with it. Well, we're already global, but actually expand it out with other teachers. For the first 300, it'll always be me who'll be teaching. And I said I might increase it to 350, but it'll always be me teaching them for life, and there won't be any ongoing fees. After that, it might not be me for others, not for you, and then be higher fees and all the rest of it. But for now, we're keeping it at this in the sort of charter members, the original 300 charter members. And we do that as well. Because I want to then, with that initial group of 300, take it to venture capitalists and say, look, this is performance. This is how they're doing. This works. We can create, like Airbnb and Uber don't own cars or homes. This is an asset management company which won't own assets. You keep your assets. You decide whichever broker you want, whether it's a Barclays or Hargreaves Lansdown or Interactive Broker or Interactive Investor or whatever, and you don't pay fees. You do not pay fees based on your assets, based on anything. What you do is you just have a one-off. And the reason is that's the only way I can think of to remove a conflict of interest. And then we thought, well, what do we do? And these are the two main things people want. They want the one-to-one driving lesson education from me. So we stole that idea from Oxford University, tutorials. And the next thing they want is the data. Okay, stole that from Bloomberg, where I used to work. Bloomberg is a data business. It's amazing as the data business. And when I used to do my show there, I realized if you've got the data, the information, you have got the ultimate power. And that's the advantage. Rich people are rich because they've got data and information which other people don't have. So we said, well, if we mix Bloomberg, multi-billion-dollar company, with Oxford University's one-to-one, well, we'll just copy the best. I mean, like I said, I didn't have any original ideas. These are just copied from other people and entities that I saw around me. And thought, well, if we just keep doing what the best people in the world do, we should be laughing. And that's the idea. That's the idea. I don't make the returns. The companies make the returns. If there's a tailwind, you do incredibly well, like 2023 and like what 2024 looks like. If there's a headwind, you step out of the way to protect your wealth. There's only two things you ever have to do. Grab a tailcoat on a tailwind or step out of the way in a year. 1 year out of 7, typically, historically, has been where you hold cash and you just make it in bank interest. 100K is what you make if you get a 20% return on $500,000 SIP or ISA. It's as simple as that. Simple as that. That's my ambitions. Those are my plans. That's where you go if you want to be part of it. I'm going to answer questions while people look at that. We are going to be raising prices again. Okay. Just so you know, and I hope that's okay with people that we're going to do that because I've been doing it for a while. Well, have you considered offering a package that just provides the proof of all this? No, we're going to keep it simple, just like Bloomberg. They have one product, one simple product, the data, and I'm going to keep it simple and focused. I'd wait for a bit and see where it will. Alpesh, if something tick value growth income, but the weekly MACD is falling, I don't look at the weekly, I look at the monthly. Do send me, it's either hypothetical, Will, send me the email and I can have a look at that for you. Okay. The other thing is, so go to that website, sorry. The other thing I want to show you is this. Have a look at this. You as a private investor, DIY, are the closest to ticking all these boxes. You need to be able to tick these boxes. If you're going to invest yourself, you need to tick those boxes. Fund managers are not. IFAs are not. That's why you're screwed. And these robo-advisor apps are not. They're good at marketing. They're the best at marketing. Guess who's best at marketing? Fund managers, IFAs, robo-advisors. Who's best at investing? You're the closest to it, to being able to tick all of these boxes. It's as simple as that. Can you give us a stock or two to buy, please? I just have. You're always saying what's overbought and what wouldn't buy. It would be nice to hear from you. If you're buying options like you did before back in January. Stan, I thought I had. Farage is not. Thanks, Stan. If there isn't, Stan. I've mentioned a lot of the ones that I continue holding. And I think there was one which came up on the list today. I'll go through it in a second and see which one it was. Matthew said JD. God, you're all going on about JD. Let me just put that on. Give me a second. Oh, no, it was just Matthew, actually. Matthew, just give me a second. I'll pull up jd.com and see what it comes to. Give me 1 second. jd.com. Okay, I don't want to go through a billion stocks on there. Okay, there's JD. It's dropped peak to trough. Where is that? About 22%. It's a baby bear because the monthly MACD is still rising. So there you go. Okay. Nothing else to say. Simple, isn't it? So simple when you're not having to be stressed about these things. And that's one of the things I want to teach people. That's it. That's it. Job done. Let's say I've got jd.com. Then that's it. Nothing else for me to teach you about JD. There's absolutely nothing else for me to teach you. Do you see how it should be process driven and not emotional driven, as Jim Simon said? Private investors instead staring, I bet everything is what's going to happen, what's going to happen, what's going to happen. I take the Warren Buffett and Jim Simon's approach. I copy billionaires. Exit rules on leverage. Oh, I think I mentioned that earlier. If there's any questions you asked earlier that I haven't, please let me know. Is there a reason you choose January to reevaluate your portfolio and pick new stocks? No, it's the first month of the year. It's not that I pick January. I don't. I do it every month for the public because obviously they're not all going to join. So it's not January. It's just the first month of the year, and it's what people. It's like the first of the month. We go. It's the first month. It's actually just a random period, isn't it? It doesn't matter that it's the first. Happens to be the first. CrowdStrike is very highly valued, but just entered S&P. 6-5-year growth projected. Great. I think I covered it earlier. Let me go through CrowdStrike. I think I mentioned it earlier. Let me go in reverse. By the way, so the link is that before I go into reverse into everything, let me just show you some important sites. So if you go to alpeshpatel.com/shares, you will see this. Okay. Oops. I'm on the wrong screen. You will see this. Okay. What is that? Well, what it'll show you is, very importantly, the education. Now, you don't need to do all this. Most people don't bother. They just do the one-to-one tutorials. They don't like reading up on stuff. They just do these one-to-one tutorials instead, which is fine. But there are a few who are retired. I have people who are retired who say to me, well, actually, I've got time. I really want to learn this. This is going to be my life. I actually want to go through all of this education material, which they can. But actually, I just summarize it and teach them one-to-one instead. And they equally like that. So I just thought I'd sort of, it goes on and on and on, as do I, don't I? So that's on there. I just thought I'd share. Oh, good Lord. It does go on and on. And we've got some videos with people as well. If you go here, you can find installments. I think somebody asked about that a little bit earlier. There are installments. You can do that on there. I also want to say, if you go onto LinkedIn, you can follow me on there. I need to do the plus so you can see it more clearly. That's me on LinkedIn. Do follow me on there because I write articles about the markets on there as well. You will see some articles that I've written in my posts and so on there. So that's always useful for resources. And my link on my YouTube, I will have a whole bunch of videos on why your pension's performing poorly as well. As to Keith, re-1 year time frame, mine is coming up now. Do I exit all the stocks just because it's no? Just have a call with me, Alistair, as well, and let's discuss that properly rather than over a quick message on here as well. Because I'll give you an example. You might have a bunch which after 12 months you're thinking, let's say you had Nvidia and it's been 12 months. You're thinking, look, this is just, there's no reason to exit it. If it drops X, I'll sell Y. But you need to have a process to manage that because you don't want to have a large bureaucracy. So we'll discuss the process, Alistair, because I think you're on the program, so it's worth discussing that. So let's have a chat about that. That's more important. On that, let me now go back to going to some of those stocks inside. Somebody said, can you give me some free stock picks? My clients get really worried about that when I do that. They get very upset. And they say, oh, why are you giving them to them, bad man? Let me show you, because I think I did mention one which looks okay out of the ones which were rising. So give me 1 second. Let's go into that. Which ones do I like? Because when I went through the stocks, I'm pretty sure I came across one. So there we go. It wasn't that, wasn't this, wasn't that, wasn't that. Tesla, I said, would probably hit a special situation soon. So I'm going to have a look at it. As soon as it's a special situation, I'll put it on Telegram. But I think it's probably going to get close to that very soon. There was another one which had come up, which was, give me 1 second. I'm pretty sure somebody might remember it. Corvo, except you might not like that volatility, but I'm fine with that kind of volatility because the MACD is there and that's there. But yeah, like I said, some people might find that stomach churning, so they don't do it. Was there another one? Autodesk, I don't have a problem with, but others might say, oh no, Alpesh, I don't like the volatility. Well, that's up to them. Then if they don't, they don't. But I don't have a problem with because it's value growth income and it's rising momentum. Okay. What else was there? I think that was the ones. So there were two, not one. Yeah, I called Tesla 2 days ago. I'm learning. Great, Will. Stop giving the peasants crumbs. Let them eat cake. You're so bad, Will. You're so bad. They can see what you've said and they can hunt you down. Remember what they did in the French Revolution. Okay, everyone. I think that's everything. I think I've answered absolutely everything. So thank you all very much for being on here. And I've sent across files. So I'm going to make sure that you've got everything that you need. If there's any other questions, just email me as well. Rashid, what is the platform you're using for viewing stocks? I'm using Trend Spider, but that isn't free. What is free is TradingView. I'm not affiliated to either. Just so you know, I'm not affiliated to anything that I've shown on here. Okay, any stocks or companies, just so you know. Okay, thank you all very much. I'm going to leave it at that. Thank you, Alan. Thank you very much. Very, 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 very kind of you indeed. Peter as well. Stan, but no reply. I think his name was Parash. Oh, Stan, sorry. Hi, Alpesh. I've contacted your assistant. No reply. Oh, email me. He should have replied, but if he hasn't, I'll give him a rollicking. Let me know what the issue was. Can you let me know what the issue was, Stan. He usually does always reply. Yeah, Paul, it's fantastic. I love it. I created it. Carwin, thank you. Rashid, thank you. Everyone, thank you all very much indeed. I'm going to go and play with my son now before he has bath time and goes to bed. I've got to rush home. I've got to cycle home. Thank you all. Oops, let me do this instead. Let me, where are we gone? We're down here. I've lost it. There's a page somewhere which would show me. Ah, here we go, because I've moved the windows around on this one. There we go. Thank you all very much. And thanks everybody who's been listening to me on TikTok as well. There's, between the two of you, we've had a few hundred people on between TikTok and the webinar. More on the webinar, which is interesting. Thank you very much, everyone. If you've missed any of the links, it's alpeshpatel.com/links. So thanks everyone for being on here on both platforms. Cheerio. Let's close that one first. 1,800 viewers. Ooh, look, that's quite nice. 1,800 on TikTok came up. Ugh. That's nice, isn't it? So anyway, if you haven't followed me on TikTok, you gotta do it. I've had 1.4 million likes by now. Sorry, it's inverted. And 371,000 followers. So that's nice. And my most popular video, can you believe it? 7.1 million views. So it's that one, the top corner. 7.1. So clearer there. Anyway, million, which is good, I guess. Thank you all very much. I better go now. Stop talking about myself. Speak to you soon.